Hello. Today we're gonna talk about the last parts of what we're gonna cover in the first exam. So we've been talking about consolidation, but we understand that consolidation is the putting together, produce a financial statements from parent company's perspective, but for the group of the parent company and the subsidiary, which is a company be invested by the parent company. And in real world, a company, a holding company, a parent company is usually called a holding company, and the holding company might have a lot of subsidiaries. In this book, we just assume they have one, but no matter how many it is, it's going to be following the same spirit. So since we are talking about the group, we know when parent company was granted control over subsidiaries, parent company will keep running and the subsidiary companies will keep running as well. So it's easy to see that they will have operation, they will be existing year after years, right? So every year, each company has operation, right? Each company has operation and then the group has operation. So from those who invest in big, in parent company, we call them big in our cases. From those who invest in the parent company, they have a strong interest, not only in the company itself, but also in the company being controlled, the subsidiary, right? If we just look at the parent company's financial statements by itself, we only see a number, which is called an investment account, which is an asset account that represents the investment of the parent company in the subsidiary, which is no way close to enough for those who are interested in the parent company. So the parent company's interest parties would normally be interested in, hey, we know there's an investment, right? We know how much it is, but I want to know what it is, right? Which items those represents. What are the liabilities? How much are the long-term, short-term liabilities? What are the current assets? What are the long-term assets, right? So they have interest for balance sheets after each year, right? Also, it's easy to see that after every year there's operation, right? If we talk about 5 million net income, right? From 6 million gross revenue, subtract 1 million expense would produce 5 million net income. 100 million gross revenue, subtract 95 million expenses will produce 5 million net income as well. But there's a huge difference because the first case represents a great profitability, would normally be much, much more interesting than our second case, right? So those who are interested in big would be interested to see that, hey, you're controlling small, you're controlling subsidiary. So I want to see that how much revenue you have together as a group and what are the expenses as group. So we have to talk about operation, but the operation is since the control was granted from the day of control. So we have to be aware of that. So in today's class, we're going to introduce 5 steps to do the consolidation, right? So what is consolidation? One thing we have to know is in real world, we talked about consolidation from a conceptual point of view. So in real world, how companies do consolidation? It's actually quite simple. So first, companies would take every year, by the end of every year, they do the same. They take the raw financial statements of big, and they take the raw financial statements of small, mechanically add them together, right? If they have the same item, they add it together to the same account. If they don't have such, add a new account. So they have those accounts, right? This is going to be the mechanical total, I call it, or total, right? Then after getting this number, they will have to follow a few steps we call consolidation journal entries, then to arrive at the consolidated financial statement numbers, right? Since we talk about every year, they have to take the raw financial statement. We mentioned this already. For big, for small, for the subsidiaries, they will always follow their own historical cost. So which means every year we have to do adjustments, consolidation adjustments for the group. So if you look at the balance sheet, look at the financial statement, look at accounting, we know it's period by period, right? By every period end, we have balance sheets. Between each balance sheets, we're gonna have income statements, right? And different asset transactions. Those transactions will generate differences between the different periods of balance sheets, right? And if you look at each financial statement, we have income statement. Income statement comes first because from income statement, we will have net income. Then net income plus dividend, we will have and retained earnings. Retained earnings will kick into the ending balance sheet, right? So if we think about this, we know if we take care of, because each period's balance sheet is compiled, basically what happened at the beginning of the year, right? Then what happened during the year. So you put them together, you will automatically have what is correct by the end of the year. So we will follow the same spirit, right? When we do consolidation, we basically we do the same, right? First, when we have the mechanical total, then we adjust for the beginning of the year, beginning of each year, right? Then we adjust for what happened during each year. Then we have the ending consolidated balance sheet financial statements of that particular year. Now let's look at an example. So here we have a similar case. We talked about the numbers already, so I don't want to go through too much details. Okay, so here we have the big, all the assets are here, book value for sure, because big don't have prospective change, right? They control small now, so small has to, when do consolidation, small has to change the perspective. Big changes for them actually. So for small, they have book value, everything here, and they have market value, everything here, right? Liabilities and all the asset items. And when big pays for small's ownership, big assess how much it's going to pay based on the market value, never based on historical cost, because it might deviate a lot from market value. So on January 1st, 2014, big paid 10 million for 80% of small. Note that upon the transaction, small's customer list was appraised with a market value of 2 million and 10 years of useful life. And we know that small's other assets, PPE, or book value was 5 million, market value was 3 million, appraised, 5 years useful life left, land, 2 million, appraised 4 million, infinite useful life. Customer list, we just mentioned, and patent, 10 years useful life, from small's own perspective, 2 million value, historical cost, but the market value was 5 million already. Okay, so I think we almost have enough to figure out everything. So keep in mind, no matter how you would like to start, it's always important to ask yourself, right? How much big paid for 80%, right? So how much, so we know that how much was 100% of the whole package worth from the perspective big, right? Then we ask, okay, what are the total market value, net market value of small's assets and the liabilities? So we can compare. If the whole package price is more than the identifiable assets and liabilities, then there must be goodwill. Goodwill is another asset that from big's perspective belongs to small, right? Small's assets. So let's do this first. We know big paid 9 million. We know big paid 9 million. For what a percentage? For 80% of small. If you are willing to pay 10 million for 80% of small of something, that means the total package from your perspective is worth 12,500,000. 10 million divided by 80%. That's very straightforward. And if we look at this, we know the total, let's ignore this first. The total market value of assets is 21 million, and bank loan is 12 million market value. So 12 million bank loan, 12 million. And we know that the net value of all the identifiable assets and the liabilities of small is 9 million. So big paid on top of the 9 million, big actually paid 3,500,000, which is goodwill we are talking about here. All right. So this is goodwill. And we can also figure out something else, which we call NCI, right? What is NCI? We mentioned already. Basically, how much we can also figure out from here. Let's just add it here. NCI at, because it's when big bought it, they paid, right? So what is NCI? Non-controlling interest. Because big controls, right? Big controls the small, right? So, but big only owns 80%. So the 20% left belongs to NCI. So big paid 10 million for 80%, right? So how much is 20%? 20% is the total package, which is 12,500,000. Subtract big's value, 10 million, give you 2,500,000 to start with. This is the NCI balance at the beginning of 2014. Okay. So here, let's put this away and put a few steps here, put adjustments here. All right. So here, let's calculate total, mechanical total first, right? We gotta take financial statements from scratch and then mechanically add them together. I won't make it too wide, so we have enough room. And we are adding items. And if you notice, let's get rid of the total numbers, because total numbers need to be calculated rather than being done by ourselves, right? Being added together like that. So if we take a look at it, there's a few question marks. In the last video, we talked about how we get this 1,360,000 investment income. I won't repeat here. And we have to be able to calculate a few different things. For example, investment, we have to figure it out. And from investment, we will know total balance, right? So we need to figure out those things. How do we figure out the investment? Right? We talked about investment. If we go back to our very first or second class, we will remember that, right? We can remember that. So what is investment again? What is investment balance? We know at the beginning of 2014, Big paid how much for 80%? Big paid 10 million. Big paid 10 million for 80%, right? So what will make investment worth more? When the investee party makes small, when big, right? Small gets income and the big will have investment income because what the investing gets bigger, right? But we know we cannot use fair value because they are not buying low and sell high, and they are just try to hold it to maturity, right? For strategical reasons. So investment income of 2014 was, we calculated already, was here. 1,360,000. And when dividend was paid by small, received by big, right? Which means the investment is getting smaller. Can we see that? So we know that we have to be able to read the financial statements. We know that from this, we know that during 2014, small paid dividend in the amount of 1 million. Were they all paid to big? Of course not, because big only owns 80%, right? So only 80% went to big. Big only cashed out 80% of 1 million. So 80% of 1 million is going to be 800,000. So we have, so the ending investment would be beginning balance of investment account plus the investment income, subtract cashed out, this much. right? So this is investment balance by the end of year 2014. So here we can put this. It's going to be and the total asset would be looks right. So now we figured this out, everything is going to be much easier. Okay, let's introduce the 5 steps first. I listed the 5 steps here, and we will follow each steps to do it together. So step number 1, reverse the beginning balance of subsidiaries equity and the change investment account and NCA account proportionally. So a few keywords. What do we mean by reverse? Reverse means making it go away. Accounting, how do we make it go away? If it were debit balance, then you set a journal entry where the same item will come in the opposite credit balance in the same amount, vice versa, right? So we do that. And then we change it proportionally, right? What do we mean by proportionally? Here, what's the proportion we talk about? Investment account belongs to big, NCA belongs to those who do not control, but only own the rest of the shares of small. So we are talking about 80-20% here, right? Reconcile the beginning balance of subsidiary assets and liabilities to market value and change investment account and NCA account proportionally. So what do we mean by reconcile? Reconcile means change, right? Change what? Beginning balance of subsidiaries assets, which is historical cost from small's perspective, change to market value from big's perspective. Change, reconcile, that's different from reverse. So those two adjustment steps, they take care of what happens at the beginning of the year, right? And then step 3, reverse investment income and change investment account accordingly. Reverse the dividend account and change the investment account accordingly. And step 5, reconcile the expense of the subsidiary to consolidation perspective. What are these, right? So 3 and 4 and 5, they take care of what happened during the year. So the end of the year will be automatically correct. Let's see how this works. Actually did this already. So step 1, reverse the beginning balance of subsidiary equity and change investment account NCA proportionally. Beginning balance, beginning of the year, not beginning of everything. So if it's 2014, we talk about the first day of 2014. If it's 2015, we talk about the balance of beginning of 2015, which is going to be the ending balance of 2014. Please be aware of that. Okay. So we know at the beginning of the year, the investee company's equity item was 1 million, 1 million, 2 million. Common stock, additional paid in capital, and the return earning, 1 million, 1 million, 2 million, right? So all we have now, when we reverse it, we debit them, right? The debit side will have 1, 1, 2, 4 million here, all on debit side. So how do we change? We know the double entry rule. So of course, investment and NCI will come in the opposite direction, which is credit, and take 80% and 20%. 80% of 4 million give you 3,200,000, and NCI would be 800,000. That's step number 1. Okay. Step number 2, reconcile the beginning balance of subsidiaries assets and the liabilities to market value and change investment account and NCI accordingly. You can see that I purposely left it blank. So we know what do we mean by reconcile, right? Reconcile again means that on small's book historical cost perspective, the value is different from big's perspective. So we need to fund all these assets and adjust for it. Something you will easily ignore is goodwill, because goodwill will not show up anywhere. Customer list, I might not show it as well. You need to pay attention, be aware of it, right? So cash, there's no issue. AR, inventory, no issue. PPE, book value was 5 million, market value was 3 million. So it's lower. You lower the value of assets. When you reconcile, you credit value for 2 million here. And then we have land. Land, the book value was 2, changed to 4. So land increased by 2 million. Customer list, 0 historical cost, increased to 2 million. So customer list, 2 million here. And patent, book value 2, changed to 5. So we increased by 3 million, debit by 3 million. And the goodwill we learned already. How much is goodwill again? Goodwill is going to be 3,500,000. So, okay, so how do we figure out how much to credit, right? You can see that we have double entry rule, which means total debit equals to total credit. So total debit here, we have 10,500,000, and there's credit item 2 million already. So which means for the left is going to be investment and NCI will add up to 8,500,000, and investment has 80%, NCI has 20%. So I will do an equation here, so you guys can check the equation. Are we right? Add up to 10,500,000, 10,500,000. So this is our segment step. Reconcile beginning balance and to market value and change investment account in fee account accordingly. Step 3, reverse the investment income and investment income account, right? So investment income was credit. If we reverse, we debit. Investment income, we calculated 1,360,000. We debit and we credit investment, change it, double entry rule, so same amount. Reverse dividend paid by the subsidiary and change NCI and investment account proportionally, right? So we know dividend paid by small was 1 million. So originally dividend was a cash dividend was a debit balance. So we reverse it, credit it, and then investment takes 80%, 800,000, and NCI takes 20%, 200,000. And last step, reconcile expense of subsidiary to consolidation perspective. So it's again, right, to the market value, based on market value perspective. Reconcile means making it correct. We have a few items like we talked about the last time, we can review it again, right? So first, let's take a look, right? 5 years left for PPE. Small will, based on 5 million, small will depreciate 1 million every year. However, from big's perspective, 3 million depreciate 600,000 every year. So expense should be lower by 400,000. Difference between 1 million and 600,000 should be lower. If we lower it, which means we have to credit, right? Credit 400,000. And of course, you debit it. We don't have, for the sake of simplicity, we don't have accumulated depreciation. In real world, we are supposed to have it. But here, let's just make it simple. And you'll be fun if you put it stuff like this. And next, we look at the land. Land has infinite useful life, so we don't worry about this. And we have customer list. Small amortize nothing. Big, from their perspective, amortize 10 years, 2,200,000 a year, right? 200,000 a year more. So here we know we have 200,000. And when we amortize, it's intangible. You reduce it, okay? And then we have goodwill. Goodwill is kind of have infinite useful life too, so we don't worry about that. And so patent, 10 years, small would amortize 200,000 every year, big amortize 500,000. So it should be 300,000 more expenses. All same amortization. So 2 million plus here 3 million, 300,000, sorry. And 200,000 plus 300,000 would give us 500,000. Looking good, right? So this is the easy part. I think when we have this, it's easy for us to write down, to produce journal entries, right? So the remaining part will become a little bit more complicated is how we're gonna generate, right? So let's do what I'm going to do is I'm going to do consolidation from a simple term, okay? So step 1, step 2, step 3, step 4, step 5. Let's take a look. Credit balance, when we put a stuff like this, debit and credit putting together, you remember credit balance, we use negative at a parenthesis. Debit balance is going to be a positive number without parenthesis, right? So common stock, 1 million, additional pending capital 1 million, return earning 2 million, okay? So what we do is we do here, beginning balance, right? Beginning balance of retained earnings. Beginning retained earnings. I will add this. Beginning balance of retained earnings, right? So what we're gonna have is common stock from, I don't like it. Common stock, 1 million. So step 1. Additional pending capital, 1 million. And note that we don't change return earnings here because return earnings we just mentioned should be generated from statement of return earnings, right? So let's keep it as it is for now. Let me just adjust the formats. And where's beginning balance of return earnings? Do we have that account? We have it here, right? We have 2 million. Easy peasy, right? So 3 items here, and we credit investment 33,200,000. We credit NCI. NCI is an equity item, by the way, equity for the consolidated, right? So we have to add one more account here. So we know that NCI is 800,000 credit, and the investment is 3,200,000 credit. So now we look at a step 2, right? We have to factor in the same thing. Lands, 2 million, customer list, 2 million, goodwill, 3,500,000. Lands, 2 million, customer list, 2 million, goodwill, 35, customer list, 2 million. Goodwill, 3,500,000. And I remember something else. Patent, 3 million. And what about PPE? Credit balance, 2 million. So investment, 6,800,000. And NCI, 1,700,000. So that's our step 2. If we want to really interesting whether we did our things correct or not, we can just add up all the numbers, and if we do it correctly, they should add up to 0 because we replace all the negative with all the credit balance with negative numbers. Okay, so now let's take a look at step 3. Step 3 is much easier. Reverse investment income, 1,360,000. Reverse, we debit, and change investment account credit in the same amount. Most of the consolidation is tedious. It's going to take you a little bit longer if you really want to see all the mechanics, like it's an open book. But we are trying to understand it, like I said, and at least from the 5 steps, they're easy to operate. In real world, it's going to be a little bit more complicated than this. So we have our step 3 filled already. Let's take a look at step 4. What is step 4 again? Investment dividend reversed 1 million. So where's dividend? Dividend is here. We reverse it. We credit 1 million. Credit, sorry about that. It shouldn't be both. So here, dividend 1 million, and we have investment account debit 800,000, NCI debit 200,000. So investment account 800,000, NCI 200,000. And the last step is going to be linked to what we talked about in the previous video, right? So we have to add amortization 500,000 and add a PP, debit PP 400,000. So amortization expense 500,000 and a PPE 400,000. PP debit, right? Debit, yeah. And we have to credit depreciation 400,000. And we have to credit customer list 200,000, patent 300,000. Now we have everything generated. Now we can start calculating, okay? When I do this, what am I gonna do? I will freeze it. Oh, sorry, freeze. I think it's here. Where's freeze? So everything is more straightforward, right? So now all we have to do is we add everything. We start from the mechanical total and we add everything. If there's nothing, we add 0 from the 5 steps. So total revenue don't change. Total fuel GS don't change. Total depreciation will be less. We explain the reason. Total amortization will be more, right? And investment income will be 0. Again, so now we can calculate what is net income. What is group income? Sorry about that. What is group net income? $18,700,000. Why 18,700,000? If we recall that we know that investment income, let's take a look at it here, right? We know that 80% of income was from BIG's perspective, right? BIG claimed 80% of the total income small made. So it's going to be 1,350,000. So NCI will claim another 20%, which is a quarter of 80%. So a quarter of 80% will give you 340,000. You add this made by BIG, then add 340,000, which will give you this much amount, okay? Which will give you this much. And the beginning balance of retained earnings, no difference. So beginning retained earnings was this much because it's reversed. And now we talk about net income. Net income is going to be a little bit tricky. How can we know what to adjust? All right, so here keep in mind, when we talk about the retained earnings, right? Retained earnings refer to BIG's parts. Only BIG cares about the retained earnings, right? Because they are calculating for themselves. So when we talk about NCI, actually NCI is like everything cooking in pots. All right, NCI belongs to non-controlling interests. BIG don't care about it. So from BIG's perspective, no matter this is retained earnings, beginning balance, or whatsoever, they just call them NCI. So when we do statement of retained earnings, we are doing it purely from BIG's perspective, right? So they should not be different from BIG's own retained earnings statements. So we have beginning balance here. Remember, net income still refers to how much BIG made, right? From BIG's perspective. So net income is gonna still be the same, which is BIG's net income, which is 18,360,000 here. Right? And then we have dividend we can calculate. 500,000 here. So the ending balance of retained earnings should be same, 43,360,000, which is again makes sense because when we talk about retained earnings, it's going to be from BIG's perspective. Actually, what we can see from here is that we know that if we talk on NCI perspective, NCI is like, okay, we have retained earnings as well. We have a common stock, we have everything else. But we prepare the consolidated financial statement from BIG's perspective, so they don't care about it. When they prepare from their own perspective, they don't really show them. They just put them together to separate, to distinguish between BIG's own and other people's. So NCI is everything in parts. So when we talk about retained earnings, we are still referring to the retained earnings of BIG instead of anything else, okay? So now let's do the same stuff here. We're gonna have our total asset here. Oops. Oh, sorry about this. I think I deleted this, okay? So you see, one thing we know we kind of did it right is we talked about this, right? Investment refers big control in small. When you put them together, there's no investment because you cannot invest in yourself. Investment becomes zero, right? So investment account becomes zero, which is a good sign. So here, let's calculate. What's the total assets? Total asset is 139,200,000. So let's look at this part. Liability is easy, equity. So two things that might be tricky here is, I mean, if it's just mechanically 5 steps, it will be much easier for us, right? Unfortunately, it's not. First thing is retained earnings. We get retained earnings from where? We got retained earnings from statement retained earnings, and statement retained earnings balance is here, right? So we cannot just doing this by adding things up, and we have statement retained earnings here. And NCI, again, we have to calculate because we didn't involve everything because we said big don't do journal entries for NCI. They don't distinguish, right? So if we just adding things up, we're going to be wrong. How do we know if it is correct or not? Here, okay. So this is BICS. Remember, we calculate this. This is BICS part, and this is, we mentioned it, right? NCI is like investment, and it refers to those non-controlling interest holdings in the subsidiary, right? So 80% of small beginning of the year was 2014 was 10 million. So we know that 20% was, of course, a quarter, which was 2,500,000, right? And investment income, big claimed 80%, and 20% is a quarter. So investment income was 340,000 for NCI. And the dividend, big received 80% of 1 million, small received 200,000, 20% of 1 million. So we know that NCI is going to be beginning balance of NCI plus their proportional incremental from the good performance of BIC, subtract the cashed out 200,000, which will give us 2,640,000. So let's factor in. Remember, it's a debit balance. And the total for the consolidated total equity and the liability will add up to equals, right? They both equal the same, okay? So we're gonna see something like this, but I don't really test you out of what we learned or what we practice. So this is gonna be what we are doing. Associated with video we're gonna upload, you will see this worksheet, and I will also prepare a practice for all of us. This is all for today's class. Thank you very much.